Hello and thanks for joining us. I wanted to give you an update with regard to the changes that we're going to recommend with our investments. Right now I'm worried about two things basically. Firstly, the American share market, and secondly, residential property prices in Sydney, Melbourne and Brisbane. Putting those two things aside, the rest of the world seems okay from an economic perspective with regard to their economies in America, Asia and Europe, indeed just travelling well. If I look at our investments though, what can we do to take into consideration all the volatility and risk that's out there? It's been a decade now since we've had the last GFC, and really it just seems a matter of time until something happens. The American market has run ahead almost a third since Trump has been elected, and if all his talk about improvements in tax reform and infrastructure spending come out to play, then there'll be improvements in the American economy. But the share market has really priced that to perfection, and really all it would take, I think, is some international incident to occur and you would see the American market come tumbling off and really dragging the rest of the world down. So with this in mind, what do we do to make investments safer right now? In our investments, we've got cash investments, share investments, property investments, etc. So I'll just speak quickly on each category. We won't be making any changes to our cash investments in that we continue to use the AMP bond fund, the UBS cash management account and the Schroders fixed interest fund. So we continue to be happy using those funds. They are safe, the money is at call, the investment term is short dated with regard to the bonds, but the return is low. We're getting like 2% to 3%. Unfortunately, it's the price of keeping your money safe. If I then move to Australian shares, we use 3 share managers to look after our Australian share positions. We use a passive and an active role, and we do this also with international shares. So our passive role is using the Vanguard fund, which replicates what's in the Australian share market. It of course picks up the fact that we have big weightings in banks, which have a concern to us because of the loans that the banks have made to all the residential properties, and also because of the government taxes that are now coming in on the banks. But putting that aside, we like using Vanguard. The cost of using them is cheap, and indeed they were a very good performer for us last year. We also like using the Hyperion fund, which specialises in medium companies which are growth orientated, and there's really minimal bank exposure there. And we also like using the Plato Fund, which focuses again on blue chip shares and pays a higher dividend than the market plus the franking credits, which is a very useful return on our money. Also, that fund has a facility where it helps protect us against any pullback in the market. So even though we hold shares, we've actually got protection against the share market coming back. In the international share market category, again, we use a passive and active combination. The passive investment again is we use a Vanguard option which is unhedged, which means that if the dollar was to come off and the Australian share market was to come off, then our investments would actually do well from a falling in the Australian dollar. We've also used Antipodes, which is an international manager who actively manages the currency. He's underweight America, and we are reducing our position in platinum, which is a similar strategy, which again, it has a currency strategy to manage the currency, and also is underweight America. But we've found platinum has underperformed compared to Antipodes, and we're using Antipodes accordingly. Our 2 favourite funds are the AMP Core Property and the AMP Core Infrastructure funds. Look, these 2 friends have been stars ever since we've had them in the portfolio. Half the money in both the investments is unlisted, so the infrastructure fund, for example, owns things like Melbourne Airport. The AMP Core Property Fund owns things like the AMP buildings at Circular Quay, Macquarie Shopping Centre. So what I like about these 2 guys is if we have a pullback in the market, you will see property and infrastructure affected. However, you won't see the unlisted assets, for example, Macquarie Shopping Centre, Melbourne Airport, drop 50% if the share market drops 50%. So again, we're investing in risky assets, but we are expecting these to perform in a more defensive manner. Incidentally, in the GFC, neither fund froze redemptions, even though they pushed redemptions back to monthly payments instead of weekly. A new fund. For the first time, we're using an alternate investment called the Invesco Global Targeted Returns Fund. And this is a fund that's going to target returns over the medium period of basically cash plus 5%, but to do it at basically half the volatility of the share market. So we're invested in this investment so that if there is a pullback in the market, this will drop less than what happens in the share market and give us the liquidity then to withdraw that and possibly use it for re-entering into other shares which may have been really hammered. Similarly, we just want our money to be safer, and we're not prepared to put it in another cash option which basically isn't giving us much. So these are the investments. We've added additional information on the Invesco fund because it's a new fund, but we're keeping with all the investments that we've got. We've slightly reduced a bit of Australian shares, moved it more into international shares, so in simple terms taken a bit out of the passive fund of the Vanguard Australian shares and put it into the active fund International Antipodes. As always, if you have any questions, please email us, we can have a chat about it, but we're not really changing the investments much. We're keeping with what we've got, we're just making it a bit safer. So thanks very much. Cheers.